So we had an amazing rally on Friday. Everything pretty much went up, from large cap or mega caps like Apple, like Google, of course, Nvidia. Nvidia always goes up. Everything is, bullish Nvidia, as many of you know. Even stocks like PayPal, which haven't gone up in a long time, are actually starting to move. Even stocks like Tesla, of course, but even cryptocurrencies. And this is a meme coin called Pepe, or I don't know how you even call it. And it got pretty popular in 2023. Every year we have one. Sometimes it's Dogecoin, sometimes it's Shiba, and now it's PP coin, and it's up pretty close to 97% in just one day. And to me, this is just nothing short of stunning of how short of a memory, people and investors actually have. That they just bought all these things in 20 and 2021, they FOMO'd in, and in 2022, some of them lost 50, 60, 80%. We heard a lot of people, they borrowed on margins, they lost some money in margin. But even after this entire crash we had, people are still doing the same thing. Even after the massive reversal in many of these stocks in 2022, a lot of the ARK Innovation stocks, they went down 80 to 90%. Carvana went down like 92%, if I'm not mistaken. And we had a lot of stocks go down, yet retail investors are stronger than ever. They are still, buying the dip. Maybe they are more educated than they were in previous crashes. But we normally have fear and capitulation. This is how these market crashes actually end. Bottoms don't look like whenever Nvidia is rallying, 100% in 3 or 4 months, just off an AI story, which wasn't present, a few months ago, and they're likely not going to make money from this AI story before like 2027 or whatever. And any company that talks about AI, the stocks go up regardless of the fundamentals, or if earnings are, good or bad, it doesn't matter. If they talk about AI, the stock goes up. And this is not, normal, but I keep asking myself, how is this, keeps happening? And the only answer I came up with is that we have so much liquidity in the system that one crash is pretty much not enough. I told my friends in my own investment group that we need something like a depression, like a 2 or 3 year depression, for all the, excess to be flushed out, for all the cash to go back down, and for retail investors to experience true fear, and capitulation. But this will most likely never happen, because the Fed showed us through SVB that they will not let anything bad happen. And now we have much lower, pain tolerance than what we had in 2008. We don't want anything to fail. We want everything to be perfect, and we want to kick the can down the road, no matter how much it costs, no matter if it's inflation or recession. They're going to expand the balance sheet as they did with SVB, and they're going to do whatever it takes to save, the system. And this is what changed for me. I was thinking that, the Fed is done. A lot of people were saying the Fed doesn't have your back because they're busy fighting inflation. But then they proved us wrong again whenever they had, increasing rate hikes and interest rates, increasing interest rates, but they were also expanding the balance sheet. This was nothing but astonishing to me, and I'm still stunned, to this moment. But this is, what really changed to me. And if you look at the massive expansion of liquidity in the Fed's balance sheet in March 2020, it's massive. One crash is not going to take it down enough, and you still have a lot of money around. You have a lot of money in money market fund. You could look, it made it pretty much an all-time high. It makes an all-time high every single week. There's a lot of money around waiting to buy the dip in the S&P, to buy the dip in the, mega cap stocks like Apple, which pretty much, runs the market. And this is how it's been, since then. And we tried to use a lot of indicators to try to get any kind of clarity around what could potentially happen or where the market could potentially go, but nothing has worked out so far. And I know many traders that have been trading for 40 and 50 years, and they tell me this is one of the most confusing markets they have ever experienced, because of the way we had, the Fed policy, the fastest expansion of liquidity, cut rates to 0, and then after that we had the fastest pace of rate hikes from 0% to 5% in 1 year. So there's a lot of things, going around and moving on, and it's very hard to come up with any conclusion or use any indicator. And this is an indicator that I've been personally using, and I personally haven't heard any of the experts or anyone on YouTube or TV even actually talk about this, and I'm not sure if it even exists. But this is something I've been looking at for years and years, and it actually does work. And it's mainly the difference between gold and the S&P 500. Now I'm going to show you 3 charts. This is the one in March of 2020. The red line is the price of gold, and the white line is the S&P 500. Now, typically gold tends to recover and makes a new high before the S&P 500 even gets back to break even. This is what happened in March 2020. If you could see the red line on the yellow arrow here, gold actually made a new high, and if you look where the S&P was, it was still, very, very low in in April of 2020. So it wasn't even back to break even. By the time, it actually went to break even, the gold was pretty much sitting at $2,000 an ounce, actually made a new high, a new all-time high. So this is what's been happening. And the indicator here is whenever gold actually makes a new high above the previous high, a new all-time high, it typically has marked the bottom in the S&P 500. After gold's making new highs, the S&P doesn't come back to the lows that it experienced before. This is another chart. This is in the 2008 financial crisis. We can see the same exact thing. This is the red line, which is the price of gold. When gold made a new high, it didn't give us like a timing indicator that this is when we should go all in. It's not like that. It actually confirms to you that the bottom is actually in, that the worst is actually behind us. And this is what happened in 2008. Gold has recovered and it made a new high before the S&P ever got back to break even. And it was a leading indicator that actually showed us that the bottom was in the S&P, and we never ever pretty much touched the 2009 type of lows. The same thing happened in the dot-com bubble. This is how accurate this indicator has actually been. Gold again recovered, it made a new high. Once gold made a new high, it confirmed the bottom in the S&P 500, and we haven't seen this bottom pretty much again. And the same thing actually happened right now. Pretty much a few days ago, I was watching this. I told the people in my group about this. I was getting notifications that gold pretty much made a new high, and it was around 2083 or 2085, and then it actually sold off very, very quickly. But if you look at the line, or at the lines that TradingView actually draws, gold did actually make a new all-time high. And if this indicator, and if history, could be have any value for us, it's actually telling us that the bottom is in the S&P 500, that maybe, October was actually the bottom, even though nothing is an indicator of that. We normally bottom after the Fed pivot. Now, the Fed haven't even cut rates. We normally bottom after we cut rates. We normally bottom whenever the VIX hit 40. We never hit 40 on the VIX. So none of that has been done. But gold did make a new high. And as I showed you 3 times in history, in 2000, in 2008, and in 2020, every time gold makes a new high, for some weird type of reason, it has been an indicator that the bottom was in the S&P 500. And we're eventually going to find out that if this time is actually different or not. If this is actually was the bottom in the S&P 500, although I personally don't think so. I think, it's pretty much, there's a lot of things that could go wrong more than the things that can actually go right. But this is an indicator that we have to respect, and it has worked 3 out of 3 times in the 21st century. So we have to look at it, and I showed it to you guys today, and it's telling us that maybe the October lows were actually the bottom in the S&P 500, and maybe the S&P is just going to keep going up from here. And as I showed you before, this, chart is very, very bullish of how it's sitting, on the March 2020, on the October type of support. If we do break above 4,200, which we have struggled to do, if we do break above that, this is an extremely bullish move for the S&P 500. But as I said, there's a lot of things that could go wrong. The market is still pricing in rate cuts for 2023. Around September, they are pricing in pretty much a 75% chance of a rate cut. Now, if inflation stays sticky, which it might stay sticky because we actually have low unemployment, we have a lot of jobs, so maybe inflation will stay sticky, and then the Fed might not be able to cut rates in 2023 like the market is expecting. Maybe then the market can freak out, maybe we have worse earnings, and this is how we could potentially reverse on the S&P, and this is the most likely scenario. But as I showed you from the gold indicator, which has been right 3 out of 3 times, and I don't hear a lot of people talking about this, but it's actually been, pretty accurate. It's telling us that maybe the bottom was actually in, that maybe we could trade flat for the year and then maybe go up in 2024, or who knows how this actually happens. But based on what I showed you and how much liquidity we have, as I told my friends in my investment group, that one crash is likely not enough. We most likely have to go up a little bit, maybe crash again in 2024 and 2025 whenever inflation picks back up and the Fed has to, hike rates again, a 1970s type of scenario. This is the only way I can see us bottoming anywhere around, fair value. But this is an argument that I had with some people on Twitter and with some of you in the comments, because I do talk about some individual stocks from time to time. If something is undervalued or if something is actually, a little bit overvalued, I try to talk about them. And even though I was very bearish in 2022, I never told anyone to be 100% cash. I never, told them to go all in, shorting the S&P 500. I always said that there's always an opportunity in the market, and I was making videos to try to help you and help myself actually find these opportunities. What I do is I keep a cash position, but I don't go 100% cash, because not all stocks are created equal. Like in 2022, we had a very bad, crash in the stock market, in a lot of the growth stocks, but I know a lot of oil investors, they were up 100%. A lot of the coal stocks were up 200%. There was amazing commodity stocks that were performing amazingly well in 2022 despite what we have. And I believe it's the same thing in 2023, where if the market does reverse, there has to be some stocks that are just too cheap to ignore, stocks that are somewhere close to fair value, maybe some healthcare stocks, some, I don't know, some, type of consumer staples type of stocks, some defense stocks, maybe that's somewhere that's undervalued, they could actually perform well. But in every crash we have, like, in 2000 to 2003, in 2008, we had the financial crisis, but O'Reilly, Dollar General, and AutoZone, and I believe Walmart were actually positive on the year. So there's always an opportunity in the market, and I never told anyone to stay 100% cash just because we think the market, could reverse. The best thing to do is to buy whenever you find something that's undervalued. If it gets more undervalued, then you will start slowly buying more of it, and then you eventually have your position built with an amazing cost basis. This is how I've been doing it, and this is how I'm gonna continue to do it. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.